Google is the most undervalued stock in the market. Yet, its share price is near all-time heights and its market cap 2.5 trillion. So, how can it possibly be cheap? It's because Wall Street has the story wrong. Looking at the company, there are reasons to believe that the shares are going to $300. If we catch this movement, there are a lot of money to be made. Are we saying Google shares will go up? Why? Let's just say I did tons of research and I applied 3 different valuation methods. The results are the same. Alphabet at $200 is a big buy. I will prove it. My name is Adri, investing is my dream, is my passion. I think about it so much, I invented my own method to value stock, the value ratio. I'm up 36% in my portfolio this year. It's mostly luck. Now, listen carefully because this is an important disclaimer. I own a lot of Google. It's almost 30% of my portfolio. I want the stock to moon tomorrow. I have $50,000 invested. It's a substantial position for me. I believe in it, I'm pumping it, so please use your brain when investing. This is not financial advice, it's just YouTube entertainment. I don't want to waste your time, but I want you to understand this opportunity. In the next 5 minutes, I will show you why I'm holding Google with a target price of $300. The first way to see value is to break Alphabet's empire apart and to value each piece individually. YouTube. I can feel that you are watching it right now. Mine is one of the 3 million videos posted every day. YouTube has more watch time than Netflix. If Netflix market cap is over 500 billion, I would expect YouTube to be worth at least the same, 500 billion. DeepMind, this is Alphabet's AI division. Together with OpenAI, this is the most advanced AI lab in the world. They just launched Genie Mode, the first AI word generator. DeepMind is extremely valuable. Consider that Anthropic, a private AI company, just got valued at 170 billion, and OpenAI has an investing round at 500 billion valuation. It's reasonable to assume that DeepMind with VO3, AlphaGo, Gemini, AlphaZero, Genie model should value at least 350 billion, probably more. Next, Waymo. Let's compare it with Tesla Robotaxi. We could argue that Tesla cars' declining business amount to 1/3 of Tesla 1 trillion valuation. Another third is the Robotaxi startup. Last one is humanoids hype. That would make Robotaxi project valued at 350 billions. I believe Tesla is overvalued, but Waymo is actually operating right now. It's leader in the space, making 250,000 rides per week and expanding quickly. It easily deserves a 150 billion valuation. Google Cloud, this is the real gem. 50 billion in revenue, growing at 30%, margin expansion and already highly profitable. Strong moat with high entry barriers. Alphabet invested 150 billion to develop cloud in the last 10 years. I think it's fair to say it's probably a 1 trillion business on its own. Google Search, this is the legacy cash cow. The story is that AI will destroy traditional search, but data show the opposite. After 2 years of ChatGPT, search revenue is growing 12% year over year. Let's be bearish and assume zero future growth. It's still a business generating 200 billion of revenue with 32% margins. With a simple 20 PE ratio, is a 1.5 trillion business. Google has more assets like Android, Chrome, Pixel smartphones, Fitbit, Maps, Waze. Let's put them all together and add another 200 billion. Summing it all up together and we get a total value of 3.7 trillions, corresponding to a share price of $307. If you're still not convinced, let's use the method used in every university finance class, the discounted cash flow. I don't like it, but it's the pillar for every value investor. We could fill up Professor Damodaran Excel, but it will take hours. So let's just use the simplified Qualtrim calculator to make it quick. Earning per share growth. Google 10-year average is 24%, last year is 22%, let's assume 18% going forward. Appropriate multiple We want to be very conservative, we don't want to lose money. Let's use today PE ratios of 21. I believe Google will see multiple expansion, but let's stay low. Desired returns. That's a tricky question. I want to double up every year. Joke aside, we want at least to beat the market. Let's use 10%. The returns from today's price would be 70.78% every year, with the price expected to be $450 by 2030. Undervalued. Finally, my own method, the value ratio. I used it 6 months ago when I made my first video on Google. Back then, I called a fair value of $250. What does it say today? Like always, we need the earnings, growth, and risk. I'm assuming 32% operating margins, that is reasonable given Google stability. Growth, only 10% revenue growth, which is very prudent since they grow 14% year over year last quarter. Risk, in my opinion, Alphabet is a very safe investment. I give it a low risk score of just 20 out of 100. These assumptions give us a value ratio under 15. The average stock trades at around 23. For Google to simply align with the market average, its price would need to be over $300. To sum it up, we have 3 completely independent valuation methods, all pointing out to a fair value around $300 a share. Considering we are trading at $200, there is a 50% upside just to reach fair value. We're talking about a Magnificent 7 stock, not some risky small cap. I think this is still a fantastic opportunity for investors who wants to make money without too much risk. However, if you're looking for something a bit more risky but with more upside potential, I would recommend you to check 3 stocks. I talk about it in this video here. 2 are already up a bit but are still very good deals. Thank you for watching Economics. Please help me out with a like and a comment. See you next week. Peace out.